most people would have no idea what they're invested in.
I think it is a common thing of like, what is it? People know super, they like the concept of super, but they're still not quite sure exactly what's invested in and how it works and why does it go up and down, and then, what are the various things that I should be doing about it.
Hello and welcome to In the Hammock, the podcast and video series designed to support you and your super, with brighter super experts helping you to build confidence on your path to your brighter retirement. We're here to make super and retirement feel a whole lot simpler. I'm David Kochie, and today we're talking about something a lot of people admit they don't really understand: where their super is actually invested. Most Australians know their balance, but ask them whether their super is in shares, property, bonds or cash, and things go a little quiet. Joining me is Damien Webb, the Chief Investment Officer of Brighter Super. Damien, good to see you. Thanks for joining us.
Hello, Kochie.
Tell us a bit about yourself.
I've recently joined Brighter Super. I'm responsible for the investment function and how the portfolio is invested and the returns that we deliver for our members. And before that, I've had about 30 years, working all the time in funds management, managing portfolios for clients and members across all asset classes, which we're going to talk about a bit later.
Yep.
I've had some experience in London as well, worked in London in the last few years. So that is me in a nutshell, and I'm very happy to be here.
Looking forward to chatting further.
We're going to tuck into some really interesting conversations around what it is we're invested in, but we will get into some investment concepts, and it's important that we cover off that this is general advice. This is not specific to individuals' needs and requirements. So if you do want to know more, you must consider your own and circumstances and potentially go get some advice as well.
Let's set the ground rules, the very basic. Because people will see words like shares,
Yes,
infrastructure,
yes,
fixed interest, and they'll see them all on the pie graphs.
yeah.
What do they actually mean?
I try and keep it simple. And I can give you some examples as well, because I think sometimes, examples bring it to life. But there are some attributes which I think are worth talking about, right? And I sort of break into two basic groups. You've got your defensive assets, and you've got sort of your growing assets. And typically the growing assets are a bit more volatile. Volatile is what we call risk. So It moves up and down a little bit more. And so over time, as you get more of the riskier or higher growth assets, they tend to be moved around a little bit more risky.
Right.
But ultimately, if we try and just break that down a touch further, under the defensive banner, we're all comfortable with a cash at bank, right? You give them, say, $100 for a year, they'll give you $100 back and you might get $5 along the way. Those are low volatility. The price doesn't really change, but you invest in those things for an interest rate, and those can be considered as a very stable, low risk investment. As you then move out onto the spectrum, there's things like shares, and most Aussies are pretty comfortable with shares. We've got Telstra, we've got Commonwealth Bank, they're all these big privatizations. So they sort of know those things. But that's what we're talking about, shares. They're a part of a company typically listed on exchange, like the All Ords, and ultimately you're buying in the future earnings potential of that company.
Yep.
So you're saying, right, CBA, great bank, is making a profit, it gives me a dividend, but ultimately what I'm really there for, I'm there for the share price appreciation over the long term. But on that journey, it will go up and down and you get that volatility or that risk. And there's a bunch of other asset classes in between which we can talk about.
Same thing with international shares, but listed on international exchanges, things like Microsoft.
I think, yes, international shares are exactly the same thing. The only difference there is you then get, let's get a bit technical for a moment, you then have currency over the top of that. Ultimately, the currency that you buy the shares in overseas, if it's in America, it's US dollars, that also will have an impact in the performance of that. It's not just a share price.
Okay. So also in the pie graphs you get in the statement, there's property.
Yep.
What sort of property does it invest in?
I think property is one thing that most people know pretty well. Most Australians, when they look at their balance sheet as they get a bit older, they've got two things. They've got a home and they've got their superannuation, or some of them do anyway. The home is typically, we call it residential, so it's the residential sector. We have the benefit of being able to invest in other forms of property. We might be able to invest or buy an office building or a shopping centre. Increasingly, there's more things around things like industrial and logistics parks. For example, Amazon's up here. You buy your stuff on Amazon. They've got to store your goods in a warehouse somewhere.
Yeah.
They will, we will own that shed and they'll pay us a rent. And that rent goes through to our members.
And infrastructure.
Yes.
What does that mean?
Yeah, look, infrastructure, again, it's a relatively newish asset class compared to shares that have been around for hundreds of years. But ultimately, it's a share ownership in a significant piece of infrastructure. And infrastructure we define as an essential service or a monopoly style asset like an airport or a bridge, or increasingly things like industrial energy like solar farms or wind farms, those sorts of things. So you can own a share in those enterprises, and they're also really good investments to have.
So when you look at your statement and you see all of those portfolios, domestic shares, international shares, infrastructure, property, basically you own as a superannuation member a little
A little
bit
piece, yeah.
of all of
Yeah.
those. And that's the diversification for.
That's right. And again, just to bring it to life, another good one is for infrastructure, Sunshine Coast Airport. We've bought into that. We own a stake of that. That's just one example. And a little bit of, Commonwealth Bank, just to bring it to life.
And why is diversification important in the portfolio?
And that's this concept whereby you can have, you can put a number of assets together, but you reduce the overall risk or variability of that portfolio. Ultimately, combining assets that behave differently. What's happening with Sunshine Coast Airport will be different to what drives the share price of Commonwealth Bank to a degree, right? Will be different to what happens with our term deposit with a bank, right? They all behave differently. You combine them together, you get a good return from the three investments, but the overall return you get and the variability of that will lower as you combine them together.
Right. So when one's doing it tough and down, the performance of the fund gets smoothed because other parts of the fund are doing well.
Yeah, that's
And that's
right.
the whole reason.
And one of the areas we do a little bit in, but is agriculture, And so, again, what is happening with, say, Microsoft versus a farm you might have out near Toowoomba that's growing something or producing something, very different. They're going to be impacted by two entirely different things. You've got this diversified portfolio that shares the burden of the ups and downs.
Yeah. You touched on a little bit earlier about the risk profiles.
Yeah.
Let's go through that and the differences between, say, conservative, balanced, and growth and high growth.
We have a lot of terms and nomenclature and names in their industry. I think ultimately what we're trying to do as Brighter Super is offer a range of options, like a menu. You go into a restaurant, you have a menu. We offer you a menu of things you can do. If you want to, you can go into individual sector options, like you can a share option or the cash option, those sorts of things. Or we think we're relatively informed in putting portfolios together. We've got a good team internally. We've got some great advisors. We'll say, listen, if you're not quite sure what you want to do with that, we can also put a pre-mixed option for you together, almost like a bit of a degustation menu, if you will. We'll say, well, if you're not quite sure, let us pick some things for you.
Yep.
But what is really critical at that point in time is we do need to know, and is important for the member to be in the right option. So, for example, going back to those two food groups of the defensive asset classes and the growth asset classes, one's lower risk, one's higher risk.
Yeah.
If you are in a lower risk option, you'll have a higher weighting to the cash, to the bonds, to those more stable investments. If you are in a high risk option, you'll have more of the international shares, the Australian shares, those sorts of things. It is really important you're in the right option depending on where you are in your life. If you're young and working, you're at 20s, you should want a high return. Generally,
Why?
Well, because over time it's been proven, despite the volatility and the variability, and I've gone through quite a number of crises, as I'm sure you have,
Yes.
and issues in markets, whether it's a tech bubble or other things, or the GFC, the global financial crisis, markets tend to recover and grow over time once you zoom out over time. The asset classes like shares that are exposed to growth in the economy tend to do well and better and give a higher rate of return than the lower risk investments.
Okay. All right. So there's no right or wrong answer in terms of your risk profile, is there? Because you've got to be comfortable with it yourself.
Yeah, it's probably worthwhile talking about, a few case studies, right? And again, you and I have shared some conversations in the past where members are in an option, for example, and there might be some variability. The market, like Liberation Day, last year with
Market crashes and all that sort of thing. Yep.
So if you are young, you have more ability to wear the variability in markets, but ultimately grow. And that greater risk for you is making sure that you don't have too little, risk in the portfolio, little opportunity in the portfolio. Equally, as you are approaching retirement, You also want to make sure that, that you've got the right mix of assets as well. And,
Right.
and the variability isn't too high as well, because as you transition from working to retirement, it's important you've got transparency of what you're going to have to live on for that
So,
period of
so
time.
it's a different thought process in your 40s and 50s to what it is in your 20s
I
and
think
30s.
so. And this is again where we're getting to that area where advice is really, really
Yes.
important. And what we do is provide a series of pre-mixed options from lower risk to higher risk.
Yeah.
And it's important that you're in the right option at the right time. And equally, as you're approaching retirement, it's really important. You might have still 20 or 30 years, God
Mm.
willing, hopefully a great retirement, do some amazing things. So you don't want to de-risk the portfolio too soon either. So again, that level of making sure you're in the right option with the right profile that's right for you is really, really important.
Right.
Yeah.
And going too conservative too early can have a big impact as well, can't it? On your
Absolutely.
retirement lifestyle in the future.
Again, we see around the world, particularly in Australia, it's a great place to be. People are living longer, and I think you want to approach, retirement with confidence and have, and know what you can do with your money, and with your family and all those sorts of wonderful things. It is important that you have the right level of growth, because if you're still investing for 20 to 30 years, you want to make sure you've got some things in there which are going to produce those returns which you need to, as well as the income to live off in that period of time.
It can be scary for a lot of people
Yeah.
approaching retirement, particularly when they see headlines around the world saying market crash trillions of dollars wiped off the share market. It's quite easy to think to yourself and say, I don't want any of that hassle. I'm going to cash because it's going to take the worry away. History tells us that that's probably one of the worst things you can do.
Yeah, it is. It can be a really challenging time. Some examples, case in point, we saw with Liberation Day, which was, an incredible level of volatility. So the tariffs were announced, the markets fell really, really deeply. Um, if at that point in time you'd said, "Oh, this is scary. I'm going to move out of my high growth or balanced growth option or in shares and move to cash." We saw then within a couple of weeks that had unwound and the market had recovered, and is now well above the where it was before.
Yeah.
And so there's quite a risk of making, what is a paper loss, or, your share price moving around, a real loss if you transfer to cash and then miss out on the recovery. That is a concern, and members need to be really aware of that, of not to be seen to overreacting.
Yeah.
But that comes back down to your plan and making sure you're in the right option to begin with, and you're at the right time frame to work through
Yeah.
these variations.
So, how often should you look at your options, your investment options, and also then your risk profile? Is it a matter that you've got to have a regular checkup on it? What do you recommend? What's a good pattern to get into?
It's important to look at these things regularly. You really want to normalize these conversations. If you've got a partner, or, have those regular chats. It doesn't have to be, scary, but make sure you know what you're in. Make sure you've got clarity around the communications. Funds.
That's sort of the first step.
Yeah.
It sounds simple, but understand what you're in.
Yeah.
When you get your next super statement, don't just look at the first page. Go to the other pages that follow that give you all the detail.
Yeah, and I think, look, we have people who can answer phone calls, and again, this is just as generally, but I think it's understand information you can get. Try and make sure you understand it, and if not, call up and ask. A lot of effort goes into making sure we provide people who can have good conversations around that, and again, then you can go and get advice. So number one, check it regularly. I don't think you need to overcheck it though. Like I think watching it 3-4 times a day, it's probably too much. And with unit prices, sometimes you can get into that game.
Yeah. Becomes addictive.
It
doesn't
does, whereas but I think, a regular health check, just like you take care of yourself, go and make sure that everything's, working regularly for yourself. Same thing with your finances and with your superannuation. Check on a regular basis that works for you. But I think certainly there's lots of tools and channels available for members with Brighter Super in particular to call up, have a chat, and understand what they're in and whether it's
because you've got to have a life.
You do.
And it's your job to look after the investment returns, isn't it?
That's
So
right.
the worst thing I think people can do is second guess their investment manager, because that's what you're paid to do.
It is.
Time to actually think about and worry for us So we don't need to do it.
Yeah, that's right. We have a large team of professional investors in-house that is looking at this every day. So you don't have to, and we've got a lot of, global advisors who can help us and navigate various markets. We've got some wonderful investment managers to buy and sell things for us as well. So there's quite a large team, a huge global team on your side inside Brighter Super and externally that are managing this and we're doing the worry for you so that ideally you can live your life.
Yeah. What are the biggest mistakes you see people make when it comes to their super investments?
It's making sure that they are in the right option is probably the main thing, and understanding the option you're in is the main one. Also, not overreacting to events is really important. So that switching conversation we
Yeah.
had, and moving to cash at the wrong point in time. Those are the really important ones. Just taking some of the fear out of it. Get comfortable with what you're invested in and inquire about it. Have a curious mindset towards it. We have lots of information to share with you and are keen to really demystify it for you and help you on that journey. That's our goal.
So it is a complex area for people to get their head around. What do you want people to take away from our conversation today? Steps that they should be taking now.
The main thing is an acknowledgement, a calling out. It is a relatively complex area. Most people have got busy lives. They've got other things they can do with their time. And more than anything else, they probably look at us and go, oh, I'm not quite sure. The main thing to take away is some comfort that it is professionally managed and is really cared for. The employees at Brighter Super and the board really care about making sure we do the right thing by the members. So we're aligned there. The other thing to take out of it is to get involved, to get curious and to understand what you're invested in. And if unsure, try out some of our tools on our website or give us a call and understand what's going on.
Take an interest, put the effort into understanding your own risk profile, time of life. That can make you sleep better at night, can't it?
Yes.
Damien, great to catch up.
Thank you, David.
Thanks for joining us. And thanks to you for joining us for In the Hammock. If you found this helpful, share it with someone who probably has no idea where their super is invested. Make sure to follow or subscribe to watch for future or listen to future episodes, and keep building your confidence on your path to a brighter retirement. Thanks for joining us.